What's going on, everyone? In today's video, we're going to be taking a look at one of my favorite strategies for scalping penny stocks and options. The name of the strategy is the opening range breakout with a little bit of a twist to fit my personal liking of a trade, but I will show you guys both ways that you guys can use and trade on your own. Before we get into the video, make sure to follow my Twitter and my Instagram, and I'll be posting more daily educational content there, so make sure to follow and subscribe onto my YouTube. So with that said, let's get right into the video. So this strategy is fairly simple to use and doesn't require anything too advanced. The strategy only works for scalping, however you're able to apply the same principles on this strategy to things like swing trades or longer term investments just on a higher time frame. So before you start, the first thing you need to do is figure out what stock you want to trade with the strategy. I personally prefer SPY, Tesla, and Amazon the most for this, but you should play around and see what works best for you. So let's get right into how the strategy works. So the first thing you're going to want to do is be on a time frame that's either the 5-minute or below. I personally like using the 3-minute the most, so play around. They're all going to be pretty much the same. This just meets in the middle of all those time frames. So next, you're going to want to look where the 30-minute mark is after market opens. So I'm on Pacific time and mine would be 7 o'clock, which is right here. And I'm going to mark down my high and low prior to that level. So right after that 30-minute mark, we can see our high was right here and our low was right here. So I've marked down those two levels, and what I'm going to do is I'm going to wait until either side breaks. So if we get a break of the upside, I'm going to play calls or long if you're playing equity, and to the downside, I'm going to play puts and short if you're playing equity. So we can see here we get close to breaking that high. We don't, so we don't take anything near it. We were ready to take it if it was going to break, but it doesn't, so we forget totally about that level. Now we're watching to the downside, and we see that we do break the downside. Now there's something that you want to note that's very important right here is that we actually get a full break. We don't just break and then wick right back up. We get a full strong selling candle. So this will be the part that's kind of intuitive on your end. You need to make sure that you can track the price action and be sure that there is enough sellers to follow through on this breakdown. So you can see right here, we're going to place our stop loss above the previous high of this candle. And we're going to track our target to, in this case, it would be the gap fill. And if it's not the gap fill, you're going to look at previous levels to base your trade off of on your targets. So if we took this trade in real time, we're going to take our first exits right here at the gap fill. We're going to move our stop loss to, let's say, around that breakout level, maybe a bit lower if you want to limit risk. And you're just going to keep raising your stop loss until it hits, or you can just keep scaling out. That exit strategy is all totally up to you. This is just one personally I would use. But let's take a look at an example of a trade that you would take to the upside. So the 7 o'clock mark is this candle right here, and we can see our high is right here. Low is totally way down there, so we're probably not going to be playing puts on that. So what we can see here is candle breaks out, great volume. Place your stop loss right here below this candle. So you'll place it right here. And you're going to enter right on the next candle. So you can either enter here, or if you see confirmation on a lower time frame, you can see that you can enter on this candle even. So if you enter, you're going to be targeting approximately a percentage based target on this rather than a level, because there aren't many levels other than the ones right here. So either one works. So you can see right here, let's say you are in this trade, you could either scale out here, or if you don't, price comes back, retests, never hits the stop loss, and just continues to rise throughout the day. But since you are a scalper, you are going to be looking to get in and out pretty quick. So you're not going to be looking for this entire move right here. You'll most likely exit around here or the first pop right there. Now, I do want to note something pretty interesting, and this is where my strategy actually gets different from most traders. They usually trade the opening right away. So I don't personally like that because the moves are much more volatile and violent. So I like to let it settle down a bit and then get my trades in. But here's an example of what a open trader would do. So here they see the high formed right here on the candle, and then the low formed on this candle. So they wait for 2 bars and then they take their trades. But you can see it's much more messy. However, you do get a bigger payout because the drops and things like that are happening much faster. So much more risk if you're actually playing the open, and if you're not, you're kind of getting a slower paced trade, but you are risking much less with that violent moves to the either side. So now let's take a look at an example of when a trade goes wrong. So you can see we have our high mark down right there and the low right there. So we have our levels listed. And now what we're going to wait for and see is a break of either level. We get the break right here, but the price doesn't hold very well and it starts rejecting from that zone. So if you do enter on the second candle, you'll most likely get faked out. But there is another thing that I want to note. As you can see, this first candle did not close above the high level. So you would have most likely not taken that trade. And this is where the price action intuitive section comes in, but you have to kind of understand that you see that there's very choppy price action and a lot of wicks. So in that first 30 minutes, you'll kind of get a feel of what the market's going to be like. And you can see here we just have a bunch of wicks to either direction, no clear movement. So we are going to expect that any breakout is going to be a big mess. So this is going to be something that you kind of pick up along the way and improve your accuracy much better. So I would personally not take this trade because I see the price action right away. First low of the day broke, bounce right back up, and then we just keep wicking right between that range. So this is something that you would love to skip trading on a day like this. But if you do take the trade with, minimal basic understanding of the concept, you're going to get faked out, and that's why we have our stop losses even in the worst case scenario. So with this strategy, I've maintained around 80 to 87% profitability win rate. So it is dependent also on when the market is in favor of breakout traders and when it's in favor of people trading supply and demand. So this is sort of a rough estimate, but it's a great strategy combining all those factors such as the intuitiveness and everything that goes into it. Your profitability rate is going to go up much higher. So I hope you guys enjoyed the video. If you guys want to see more like this, make sure to like, comment, and subscribe, and let me know what you guys want to see next.